Good afternoon. It's the 16th of April. This is the Market Pulse. My name is Adishan Nadu. I'm joined once again with Tom Gale, Executive Global Markets Trading. How are you doing, Tom?
Yes, hello, Eddie. Good to be chatting again. I'm very well, thanks.
That's good. Yeah, it is good to be chatting. I feel like our markets, okay, we've had a bit of a break with Easter. We've been back. We took a bit of a break from our pulse last week. And we obviously kick off again. We did some stock picks just before we took a break. It looks like our markets stopped trading on headlines. Seems like there's a little bit to be cautious, less cautious now. It's more coming back to a norm. But what can you see and what can you bring us? What can you bring the listeners?
Okay, yep. So as you rightly say, we've approached the JSE stock picks in two parts. So on the previous Pulse session, we covered a number of our top stock picks, and today part two will cover the remainder. Before we do that, as you rightly say, the conflict in the Middle East has persisted, at least insofar as energy prices remain elevated, and of course supply in and out of that Strait of Hormuz is continues to be restricted. The initial concern was, of course, around inflation, because higher oil prices will lead to higher inflation. But the inflation shock could be looked through and is starting to be looked through by markets when we then consider what the long-term damage may be to global growth, so a knock to GDP. And with that in mind, we did hear from the IMF, the International Monetary Fund, earlier this week, and they downgraded their assessment of global growth due to the conflict. So now for 2026, global growth will slow to 3.1%, said the IMF. Absent the war, global growth would have been 3.4%. Now, this situation is fluid, and the IMF further warns that under an adverse scenario or an extreme scenario, that actually global growth could slow to 2.5% or even 2%. And at that point, you're certainly not offsetting population growth, and so you're actually looking at what effectively would be recession in key parts of the global economy, and per capita, you're certainly getting subpopulation growth, which is problematic. So we're starting to see global indicators and key market indicators price for slower global growth, but actually conversely and perversely in the short term, this does create a bit of a tailwind for markets. Perhaps if you start to see looser financial conditions rather than more restrictive financial conditions under a purely inflationary backdrop. Now, one of those indicators is, again, and Adi, you'll have to bear with me, as will your audience, but a slower expectations of slowing global growth does impact indicators such as the oil price. So as much as oil remains of key concern and supply of oil is particularly chronically a concern, and we do hear stories and we do read headlines of fuel supplies running very short, particularly in Europe, in the UK, and airline stocks, for example, warning of running short of oil stocks. We can, under that scenario, nevertheless see lower oil prices because of the destruction of global demand. So most of your audience will be familiar with the fact that oil prices, as we refer to them, very near-dated oil prices for near-dated delivery, typically right now June delivery, in the mid-$90, down from some of the higher prices that we were getting used to at $110 or thereabouts. In fact, we often talk in markets about the oil curve, which, as you can see, I'm sharing a picture of that curve in steep backwardation. That is to say that it's higher on the left and lower on the right. And if we follow the oil curve, perhaps I've circled in red down towards the end of this year, so let's say December delivery, December 2026, we can see that the oil price is actually closer to $80 and may well drop below $80. So the point I'm making here is that we're perhaps starting to see indicators such as the oil price starting to price softer global growth, demand destruction, given how high oil prices had got very quickly. The other thing to say, Adi, is that it's been our thesis, and we're not alone in arguing that the dollar walks up the stairs, in the words of our G10 currency strategist Steve Barrow, but then comes down the escalator. Here I'm sharing a chart in blue, the dollar, which we often refer to in markets, DXY, and in white, a real effective measure of the dollar. Now, I don't want to get into the details here particularly, except to share that whichever you're monitoring right now, the dollar has been a little weaker recently. So we're out of the immediate crisis for markets, this would tell us. And actually now we are back talking about the debasement of the dollar. And a large part of the debasement argument is around diversifying central banks globally, diversifying away from the dollar holdings, perhaps adding gold and other currencies. And we're going to see that as geopolitically the world becomes more moving away from wanting its alignment with the US.
So as you're speaking about the dollar and the fact that it is, I mean, I said I don't want to spend long on the slide, but the debasement of it, you could say that it's across multiple currencies. Right? So you're not just speaking dollar rand, you're speaking dollar euro, dollar GBP, you're speaking dollar across multiple pairings, right, or FX pairings.
Yes, that's right. So you're right to pick up on that. DXY is a basket of currencies against the dollar, and that's how we have to think of the dollar, because that's ultimately what it is. The DXY version of the dollar is heavily weighted to the euro, which is sometimes why we look at a broader measure, perhaps BBDXY, big Bloomberg big dollar measure, or a real effective, which is also weighted for trading partners and so on. But
I don't want to cloud that. Sorry, Tom. So I don't want to cloud that for the listeners here who actually utilize our platforms in online share trading and Shift, who would be able to trade this currency, or the dollar, utilizing either a currency contract on online share trading or the currency pairings that are available in WebTrader. So I'd say trade this with caution. And as you said, it's heavily linked to a specific major currency pairing in the dollar euro, but it's across multiple currencies. So there's a lot of opportunity there for clients listening here today that can obviously utilize the dollar trade. And even in your previous slide, in terms of taking advantage of oil with the currency contract that is SP oil, it's the ETN on OST as well as the CFD. So there's opportunity here in what you're kind of explaining.
Yes, and you're right also to add that. I would just caution that it is tough to get the peaks and troughs in the dollar, certainly. And actually, we are all exposed to the dollar through dollar rand, of course. And so, perhaps we need to, at least for the purposes of today's call, just consider that the gist of my narrative here is that actually dollar weakness broadly will continue to favor a lower dollar rand, that is to say a stronger rand. It's an argument we've been making for some time and will continue to make. As you get bouts of risk off, of crisis in markets, of course the rand is going to weaken, and conversely the dollar will be a bit stronger, but the broad general direction of travel will be dollar weakness, and that makes it a little easier for us to call for rand strength. There are other reasons to be constructive on the rand, and you and I have talked about this at length over the last 12 to 18 months, Eddie. But one of those factors would of course be platinum prices, PGM, platinum group metals, where the recovery continues. So too gold. In fact, I think that I'm correct in saying and reminding you and your audience that something like 20% of dollar receipts into South Africa are from our platinum group miners, as well as our gold miners. Adrian Hammond, who is the analyst in SPG Securities who covers PGMs and gold, has been, and we've covered this too, telling us that he's far more constructive on PGMs, and there will be industry tightness in PGMs, even in a slowing global growth environment. So even with that warning that we talked about from the IMF of slower global growth, his forecast for platinum and for broader platinum group metals is still constructive, even if there's 10% decline in global auto sales. And I think that's worth bearing in mind. In other words, platinum group metals and his forecasts, let's say $3,000, for example, for platinum by next year, is somewhat recession proof. He's already recession proofed that. So we that brings us neatly actually to what we want to get to today, which is part 2 of our JSE stock picks. That's right. And you and your listeners may recall that last time round we covered off fairly briefly the SA banks, and we talked about Pepcore and Clicks within our the stocks that we favour amongst industrials and consumer stocks. We also covered off Remgro. So today we're going to cover platinum and coal stocks, as well as MTN, Mondi, and Raubex. We don't have an awful lot of time, so we can't go deep dive. Those who have access to the podcast that we're currently engaged on will be able to sort of pause and have a read of the slides, and of course some of the research is available on the online share trading platform. We've talked briefly about our fundamental view then of the PGM industry. Part of the thesis is not only demand, and we talked about auto sales, but also declining primary supply. That is to say that there's less of the metal and the platinum group metals being dug up. There's also less of an overhang, not only from mine supply, but actually secondary supply, which typically comes from the recycling industry. Think of catalytic converters that make their way to the scrapyard and are therefore mined for their PGM loadings. There's less of that metals available for various reasons, and as I mentioned, on the demand side, it's mostly about auto sales. A number of Chinese brands breaking into new markets, and we're talking there about internal combustion engine cars rather than the electric vehicles, because those are the ones, the ICE cars that host those catalytic PGM loadings. Okay, so as I mentioned, platinum we see at $3,000 then by 2027, palladium $2,300 an ounce, and rhodium all the way up at $35,000 an ounce. It's currently trading around $10,000 an ounce. And I know that you want to mention something to your audience here, don't you, Addy?
No, but I mean that's quite a big high, and actually, these are all available for trade as well in the platforms. I mean, these crosses. Rhodium, I'm not 100% sure if it's available, but that's quite a big opportunity.
Yes, indeed. So you're right. And by the way, if you're catching some of the noise in the background, we are hosting the call from the trading floor. So this is normal background noise in this zoo. But yes, so you can trade the metals if you wanted to via the ETF listed on the JSE and available to you on the online share trading platform. ETF PLT for platinum, ETF PLD for palladium, and ETF RHO for rhodium. But we actually prefer the producers, so Northam, Valterra, and Impala, because they offer you some operational leverage. Northam's our top pick, and we've got a price target of 700 Rand. They, in the view of our analyst Adrian, have superior fundamentals, best sales growth and long life assets. So Adrian's top pick being Northern. Valterra also, he's got a buy and a price target of 2,500 rand. Long life assets and superior processing capabilities. They've got the refiners. At Makhala Kwena, they've got growth optionality. But do just bear in mind that they are most exposed, Valterra is most exposed to higher oil prices, which does put some of their cost guidance at risk. Impala, we like the operational leverage there into these metals prices. Sibanye is an odd one. They do span gold and PGM projects. For now, we have a sell on that one, but of course the stock price will go up as long as gold and platinum prices are going up. We'll keep moving, Addy. Let's talk about coal miners. Coal is a topic that we've covered off briefly in the recent past because with the global energy disruption, coal has been a beneficiary. And we do expect ongoing elevated coal prices given the disruption, in particular in natural gas markets. Coal is something that South Africa is well endowed with, and so as we dig it up, the producers do maintain a very cash generative position, which is positive if you want to own the underlying stocks for the prospects of good shareholder returns, typically through dividends. For those of in your audience who would question the ability of the producers to get not only coal out the ground, but then transport it to where it needs to get to, well, we've been constructive on the outlook for the Transnet rail recovery. Performance will continue to improve over time. So our top pick amongst the coal producers is Exxaro, and we've got a price target of 245 rand. A lean balance sheet, and as I mentioned, there is the prospect of additional shareholder returns. In fact, management recently said that they won't rebuild their cash buffer. They used their cash buffer recently actually to acquire in the manganese sector. And I might just add that in terms of earnings for Exxaro, it is about 50% coal. Thereafter, Exxaro is exposed to iron ore, I should say, through its stake in Sishen, in the Sishen mine, and then about 10% in energy. So there you have it. We do like that the Eskom, that some of Eskom's coal sales are to, some of Exxaro's coal sales are to Eskom. That gives it a nice sort of annuity earnings, which is nice and defensive. So Exxaro being our top pick. Thungela is one that really got a little bit of relief from coal prices being higher and the dollar rand being a bit higher too recently. We like Thungela. We have a price target of 160 rand. What I am particularly endeared to here is that there's with the expectations of bumper dividends, shareholder returns of 26.5 rand over the next 12 months, you're getting a yield on Thungela stock of about 16%, and that's probably about as good as it gets anywhere on the JSE. 16% dividend yield. Addy, I'm going to move on from the miners, but certainly PGMs and coal are really where we favour the operational leverage, and we like the commodities themselves. But let's keep moving. We're going to cover off MTN, then Mondi and Raubex, and we're going to keep moving at pace here. As I say, if you able to pause the webcast as you go, you can have a read of the slides.
100%.
Okay, well, MTN, we still have a buy on the stock. They had good earnings recently, good results that have been pegged back over recent times by performance in SA. SA revenues have been under pressure given a very competitive South African market, and it's actually really been Telkom that's been performing particularly well in the local market, and that's kept earnings and revenues under pressure for both MTN and Vodacom. But otherwise, MTN has this really impressive footprint across the African continent. And if we're going to talk about those African markets that are in a position to benefit from global geopolitical upheaval, well, Nigeria is one of them. They produce a lot of oil and they refine a lot of their own product now through the Dangote refinery. Why am I telling you this? Well, because group earnings for MTN have been boosted by Nigeria in particular, as well as Ghana, Uganda, and Sudan. Nigeria is really very important to MTN's group revenues, and in fact, across all of those markets on the African continent, well, constant currency service revenue growth of 23% year on year in the recent results is well above the minimum of their medium-term guidance, which is for high teens growth. So we would own MTN really on the strength of its pan-continental footprint. Mondi, Adi, I'm going to introduce as actually our best value investment opportunity, certainly amongst the resources. And we talked about platinum group metals, and we talked about coal. But if you're looking for a stock that on its own screens cheapness, it is Mondi. So the others you're going to buy because the prices of the commodities are doing well. But if you're looking for a stock that is well managed and is screening historically cheap, you've got to look at this paper producer. Mondi recently reported some soft results, and it is absolutely the case that paper markets in Europe are under particular pressure, partly because of what's going on globally, but also because of excess capacity, typically from recycled containerboard and so on. But get this, in terms of valuation, and we like to look at EV, enterprise value to earnings, as our preferred multiple for this stock. Well, we're highlighting that Mondi is trading at a 14% discount compared with an historic 10% premium. So that right there is why we'd own Mondi here. It's because it's very cheap. Are you going to get a quick turnaround in paper markets? You may not. So Mondi is one that you're going to buy now because it's very cheap, and you're going to keep hold of it. But if you're looking for the re-rate story, well, it could be that price increases might start coming through in that key European market, and potentially as soon as later in this year there could be another price increase from Mondi. But what is Mondi doing to self-help? Well, they've lowered their capital expenditure profile for the full year, and that should lead to more cash available, and that more cash might be used to reduce debt. So debt's looking better, the balance sheet then for Mondi's looking better, and besides, we've all forgotten about the Russia-Ukraine conflict because we've been so attuned to what's going on in the Middle East. But if Russia and Ukraine were to come to some sort of agreement, then you're also getting a boost for the paper market in Europe. So we say Mondi, extremely cheap for something that is very high quality. You buy it and you hold it. We're going to close off on this one, Raubex. It's a stock that you and I have talked about before, actually, Adi. It's for a long time been a top pick of our equities team, and it's never a ride, without speed bumps in the road. And in fact, I think we introduced Raubex as one where there's been a share price pullback recently, mostly because they had actually mixed, or even in some pockets poor operating results in the first half of the current financial year. They had to write down a problem project in Australia, and they're coming off a high base for their chrome mining operations. But what we would focus on, aside from what's been a particularly weak a pocket of activity in the buildings market in South Africa, well, let's actually look to what is their core business. And their core business is road and earthworks, as well as infrastructure. And those core businesses have continued to perform really well. If you strip out some of the problem contracts in Australia, and if you strip out the chrome mining business, then you actually see that Raubex's core business grew earnings 12% in the first half, so that's pretty good. And Raubex still has a really healthy order book, so that means pipeline business that's going to feed through. We like their exposure to Sanral. Between these guys, Raubex and Wilson Bailey Holmes, for example, they're benefiting from the spend that's coming through from the South African National Roads state-owned enterprise, and this will actually step up over the short to medium term, and Raubex is very well positioned for that, as I say. So with order book growth reaccelerating and management which we have in high regard, we think that Raubex is one to own. We've got a price target of 60 Rand. So I think, Adi, you'll help us round up here, but I think in summary, given the knock to the JSE over the last month or month and a half, there have been opening up some opportunities, some pockets of value, and I hope that over this session and the previous session that you and I hosted, that we've highlighted some of those opportunities. We remain very constructive on the outlook for JSE equities.
I mean, it's a great way to tie it up, and as you said, it's a nice continuation from the pulse previously. And the stock picks are always very valuable to our client base, considering the fact that there's placed pockets to find value, considering what's going on as well. So always great to have this, and looking forward to what you'll bring the listeners next week, Tom. And until then, we'll chat soon.
We will indeed. Thanks, Adi.